here for our ETF Spotlight, and today looking at quality stocks versus value stocks.
Yes, off Wall Street, people might think quality and value have very similar meaning. Not really here. In fact, there's something close to opposites right now. Quality stocks have been holding up this stock market. There's an ETF, QUAL, that essentially does follow a strategy of buying high-quality companies. What does that mean? High return on equity, low debt, very stable earnings, very, very familiar names in here. That's the white line there. You see the outperformance over a year to date. The RPV is a pure value ETF. So it's S&P 500 stocks that follow very strict traditional value metrics like price to book value, price to sales, price to earnings. You see how much that has lagged right there. So essentially, buying the cheapest stuff in the market has been a really poor strategy relative to buying some of the most expensive but highest quality stuff. It's kind of a get what you pay for type model. It's not always that way, but this cycle, it's happening that way. Part of it is because of the cyclical uncertainties, the global growth questions right now. Look at the biggest holdings in each of these. They'll give you a flavor for exactly what these styles mean. The quality ETF, it's J&J, Apple, MasterCard, Facebook. 3M's interesting, of course. The stock has done very poorly, but has a very long history of earnings stability and very high-quality balance sheet. And then you look at the RPV, and you're going to get some cyclicals and some financials in there. Ford Motor Company, Cody's an interesting one, basically a kind of a depressed consumer products, MetLife, Pru, and of course, Baker Hughes, GE. So, if you want to play mean reversion and you think that the Fed rate cut is going to bring cyclical, less high-quality companies back into the fore, RPV probably is dry powder in that regard, guys.
I wonder what it says about the fact that growth stocks are sort of redefining themselves. We were just talking with Jim Stewart about how some of the FANG names are not performing that well anymore,
right.
But we do have these IPO darlings.
Right. The IPOs benefit almost from the lottery ticket mentality that already paid off for the FANGs, right? So I do think there's some of that idea of like, this is finally some undiscovered growth, at least in some of the software areas. I see that's kind of what we're doing. And also, maybe we're going to buy companies that are going to get bought by the big guys who are going to be looking for growth down the road, too. So I think once the sense of inevitability about FANGs, kind of open-ended growth got challenged by the regulatory stuff, I think that's when you had to shake out some people out of that idea that they were can't-miss stocks.
Yeah.